What's up, guys? Welcome back to DCA. So what we're going to do in this video is cover probably the single most important topic for those of us who consider ourselves to be crypto investors. We do a lot of market analysis here where we look at market dynamics, price fluctuations, which assets are presenting value to the investor, and lots of other aspects of the market along those lines. But hands down, the most important thing that we look at here can be thought of as how to improve the way that you are approaching the markets. How to approach the market from a non-emotional state so that you're clearly seeing the data and ignoring all the surrounding noise. Because ultimately, the ability to think clearly and rationally, non-emotionally, when things are looking like they're at their worst, is going to make the difference between being massively profitable in this space versus making the same mistakes over and over and over again. But let's face it, quite frankly, it's easy to talk about adversity. And for a lot of people watching this video, this bull market was their first trip to the rodeo. So now that we've entered into this bear market, you can have all the planning, all the strategy, all of that in place. But when it comes down to it, action can be quite a bit different from intent. So I think we all have a fair understanding of how these bear markets go, and nearly everyone is feeling the pain through this stage of the market. But today I want to look at a specific example of exactly how I approached the market back in 2018. So today we're going to use the DCA Index risk model in order to look at exactly what dollar cost averaging into the market with a dynamic dollar cost averaging approach looks like. We're going to look at how terrifying the market can be as you go down huge amounts at points, being down 40%, being down 50%, as the market just looks like it's never going to recover. But ultimately, how perseverance, how conviction, how having a plan, and more importantly, sticking to that plan pay off huge in the end. So that's what we're going to do today, guys. Let's do it. Okay, guys, so we have a ton to cover today, so I'm going to get right into it. Everyone wants to learn how to be a millionaire, but they want to know how to do it in under 10 minutes. So we have a lot to cover. So we need to start by understanding what the DCA Index risk model is, because in order to understand the analysis we perform today, you need to understand what this model is, how it works, and how to use it. So this is a machine learning algorithm model, which is just a statistical method using AI in order to understand where market cycle tops and where market cycle bottoms occur. So everything we do on this channel is focused around data analysis of the cryptocurrency market. Now, this model, if you're interested in using it yourself, it's available for free on the Discord channel. You could head over there to sign up for it. Now, what this is a model which basically says, where is the point at which the market has run up too far, too quickly? This is a bubble, a market bubble has formed, and the market is very likely to turn around from where we're at. So that is when you get into these highest points. So the model is scaled from 0 to 100. You can see over here. When we are in this 90 to 100 range, that is indicating that we are very likely at or near a market cycle top. Okay. And you can see that in every single market cycle. So we have back here in 2013 and 2014, it indicated that we were at or near the top in both cycles. Then again, here in 2018 in December, and then again here, it actually topped out in February. Now, you quickly might say, well, February wasn't the peak. The DCA Index risk model doesn't care where the exact dollar amount peak is. It wants to know where is the most value that can be extracted from the asset in order to get you into the asset and out of the asset at the appropriate times. Because if you got out of Bitcoin right here in February, you had time to shift into the altcoins before many of them went on their run. Because ultimately, many of these assets are going to go on their massive runs as liquidity is pulled out of Bitcoin and then moved into the altcoins. That's why we always see Bitcoin top out first, followed by a huge run from altcoins. We even saw that happen back here in November of 2021 when we went on that second run. Okay, so basically that's what the DCA Index risk model is attempting to do in a nutshell. Now, what it also does, however, is identifies when are the best times to get into the asset. So it's helping you get into and out of the asset. So when we're down at these lowest risk levels, so below 20, below 10, these tend to be extraordinarily good times to buy the asset if you have a long-term time horizon. If you're a short-term investor, these may not be the best times to buy. But I don't do short-term investing on this channel. I don't talk about it. I don't care about it. The gains are not nearly high enough to warrant participating in that side of the market. I don't care about making 5 or 10%. That's not even worth blinking at in this market. So we are invested in the crypto market where we're taking on extraordinarily high levels of risk because we are presented with the opportunity to gain extraordinarily high reward. That is why you invest in the crypto market, not to make 20%, 30% on short-term trades. If that's your thing, that's fine. You're just not going to find it on this channel. All right. So we see that the index identifies for us using this machine learning model, both market cycle peaks and bottoms. So you can see that at every single bottom, the DCA Index risk model has indicated to us that, we're down below 10. This is very likely to be a generational buying opportunity. All right. Now, currently we're trading at 17, but you can see back here for instance, back here in October of 2014, we got down into this below 20 range, but there was still a lot of pain left to be had in the market. In fact, if we just zoom in here, we were below 20 starting right here at the beginning of October, and we were trading at around $300, but nonetheless, we still went down to $150. So, there was still a lot of downside left in the market. But it's at least a consideration. Just because you're in these lower risk ranges below 20 does not mean that you're at the bottom, all right? It doesn't mean that by any stretch of the imagination. This model is not trying to identify the exact bottom for you. We don't know where the bottom will occur, all right? If I knew that answer, I would just tell you that answer. We don't know where the bottom will occur. So this model is looking at the probability that we have entered into a market bottom, all right? And that has classically occurred when we drop below the 10 level. So we've got down close to it. We haven't dropped down all the way below it. But even if we did drop below it, that wouldn't necessarily indicate that you're at the bottom, because based on macroeconomic factors, et cetera, you could always potentially go lower. But if you have a long-term investing time horizon, that's why we use this model, because we never know where the bottom is at. So we want to appropriately invest our money into the market based on the probability that we're at the bottom. So when we're below 50 is when I start dollar cost averaging into the market. And when we're above 50 is when I start selling out of the market. And the way that I do this is by dynamically dollar cost averaging. So what does that mean? Dynamically dollar cost averaging indicates that when you are in this 50 to 40 range, when you're in that 50 to 40 range, and I've just used an example, I've made up some numbers here that we're going to use for our analysis today. So when we're in that range, we're going to say that this hypothetical investor that we'll be looking at today invests $100 per week. All right. So they invest $100 per week. That's their baseline. And that is what you're going to do when the DCA Index risk model is right here in this 40 to 50 zone. So every time we're in that level, every time we're in this 40 to 50 zone, you're going to invest $100. And the way that you do it then is you scale up as the risk of investing into the market scales down. So when we fall below the 40 to 50 range, then you'll increase your investment. So you'll go 1.5 times what you previously invested, and then you'll do $150. So when you're down 30 to 40, you'll be investing $150. Then as you scale down farther from 30 to 20, you'll invest $200. And this is weekly. That's how I approach the market. I do it weekly. If you prefer to do it monthly, if you prefer to do it, bi-weekly, whatever it is, you have to change these values to suit whatever your needs are. So as the week comes to an end, it's my dollar cost average day. If we're down in this 20 to 10 range, then I will dynamically dollar cost average $250 instead of $100. All right. And then finally down here in this lowest level, then it would be $300. All right. But you could change this to however you feel is suited for you. This is how I do it. Now, on the same way that we're buying as we go down farther and farther and farther on the risk metric, we're going to sell an increased amount of the asset as we go higher and higher. So when we're at 50 to 60, we're going to sell 5%. When we're at 60 to 70, we're going to sell 10%. 70 to 80, 15%, 80 to 90, 25%. And then you could see here 45%. In other words, we've got completely out of the asset once we finally get up to this 90 to 100 zone. So once we're in the 90 to 100 zone, we have completely exited the asset. And today what I'm going to do is walk through an example of how this went back in 2018 into this current market cycle. Okay, so that was the DCA Index risk model for Bitcoin, but notice that we also have the model for Ethereum. We have it for Bitcoin, Ethereum, and pretty much most of the top altcoins, primarily the layer ones, but some layer twos, and in Polkadot's case, as people love to mention every single time I talk about Polkadot, it's layer zero. Okay, so we have it for layer zeros also. By the way, I've done a lot of extensive research on Polkadot. I'm aware that it's a layer zero, but when you're comparing layer ones, it's obviously makes sense to throw Polkadot in there also. So we have Ethereum, and you can see this is the DCA Index risk schedule we're going to use in this analysis. So $50 per week at this 40 to 50 range, 75, 100, 125, 150, all the way down at 0 to 10. So when the risk is at its lowest level down in the 0 to 10 range, you will invest $150 per week. So that is how we'll approach the analysis for Ethereum. At its most basic level, you will be investing $150 per week when we're in the 40 to 50 range. And that because remember, the $100 for Bitcoin and the $50 for Ethereum. Now you're going to invest based on the risk for each individual asset though. So if Ethereum this week is at 20, but Bitcoin is at 40, so we'll look at Bitcoin again. When Bitcoin is at 40, you're going to this 40 to 50 range, you're going to invest $100 per week. But when Ethereum that same week is at 20, then you're going to do 125. So your total investment that week would be $225. So you kind of have to think about this then in terms of how much money do you have free to invest? And I'll talk about a bit later how you can sort of think about this, because we can look at the average investment amount over an entire bear market and how much free capital you may need to have in order to approach a strategy. That will help you come up with a number for yourself in each individual market cycle. Okay, so we're going to start here in 2018. And we'll just quickly think about where did you start investing at? So you're not going to invest up here when Bitcoin is at 20K, not when it's at 15K, not even when it's at 12K, because notice the DCA Index risk model is above the 50 level at each one of those prices. So we're looking right here, right around this time, the price closed at around $10,000. So right around $10,000. That is where you would have started investing. So as we came down farther and farther, as the market got farther and farther down into the bear market, we came all the way down to around 6,500 and we were holding sort of the 6K level. So right around here, we were holding this level as support. We pretty much rode between that $20 and $30 level. And you can see that during that time, we were investing 2x. So 1x, 1.5x, 2x. So $200 during pretty much a large majority of that 2018 bear market. But then what happened is we dropped below that level. We dropped below that level right here in November of 2018, and we got down into the 20 to 10 and the 10 to 0 range. But notice that this was a relatively short amount of time. So the entire time that we spent below this 20 to 30 range spanned from here in November through here in March of 2019. So about 3 or 4 months. But this is important because this is what separates a strategy like this from other strategies, including a static dollar cost average strategy. All right. So we drop down here and the model's telling you, hey, it's probably very likely that you should start getting more heavily into the market right now because of the fact that this is a place where we are typically at or near a market cycle bottom. And that's exactly what we saw. So this ended up being down here in this bottom range, just like it was back here in 2015, in January of 2015. That was the market cycle bottom, right when we got down to this lowest risk level. So the risk hit around, it hit around 8 on the DCA Index risk model. It hit down to around 8, and that was the market bottom. And from there, the market started to recover. And we sat anywhere between this 50 range all the way down to around 20. There was one more time where we got down between 20 to 10, and that was during the COVID capitulation event. And, you basically had 2 or 3 weeks to invest at that level, if that. I don't even think it was that long. All right. So now what you can see is that we have headed into this bear market. We have spent quite a bit of time now, again, right in this 20 to 30 range, right in that 20 to 30 range. And less so, we've spent some time down here in this 20 to 10 range. And so that sort of makes sense. We have had some rather large capitulations, including this most recent capitulation that we saw where the price bounced all the way down to around 25K. And so the model is telling you, I don't know if we're at the bottom, but we very well may be near the bottom. Okay. Or at least in the long term, this is very likely to be a great time to be buying. So in general, that's how you use a metric like this. Then on the way up, you're going to sell just like you buy on the way down. All right. So if we enter into this stage right here, into this bull run, when we hit into the 50 to 60, 60 to 70, you're going to look at how much Bitcoin you've acquired up until this point. Because remember, after this point right here, you're not buying anymore. You're not buying when it's at 50 to 60, or at least I'm not buying. This isn't financial advice, so you can do whatever you want. I'm not buying here, so I look at, let's just suppose that at that point, right here, that I've acquired 50 Bitcoin, okay? Suppose that I've acquired 50 Bitcoin right here at this point where I start selling. And remember, I'm selling when I get above 50 on the DCA Index risk model. So I'll look back, and when I'm in this 50 to 60 zone, I'm selling 5% of that 50 Bitcoin. Then when I get into this next range, this 60 to 70 range, which occurred right here, I'm going to sell then 10%. All right. And then 15%, and then 25%, and then 45%. So in other words, I will have sold all of the 50 Bitcoin once we get up to the top. And I'm not buying during this time. Why would you buy the asset in a bull market? That's insane. You should be selling the asset in a bull market. People that are buying an asset in a bull market are not typically profiting. They're losing. They're losing money because they are simply put their exit liquidity for people that were dollar cost averaging back here in these stages of the market. People that are recommending to you to FOMO into these assets, buy the dip, that sort of thing, when we're in a bull market, that's not good advice. That's never good advice. And unfortunately, it's the most common advice that you hear on YouTube. So that's why people continually get wrecked, because they're listening to people tell them buy the dip as we're in a bull market. That's the opposite of what you should do. So having something like the DCA Index risk model gives you a plan. It gives you clarity on the market, where we're at and where the top as well as the bottom is likely to be. So with all that said, let's break down the numbers then of how this would have played out. Okay, so I'm going to start by showing you just the charts for Bitcoin and for Ethereum. Individually as assets, how would this have played out for you? And we're going to just look at the general dollar amount first. That's the first thing we're going to do. And then we're going to break this down into more specific examples. So if you started dollar cost averaging using the DCA Index risk model exactly as we prescribed, over that period, from 2018, the beginning of 2018 through 2021. So this is a 3-year period, essentially. All of 2018, all of 2019, all of 2020 through February of 2021. And in fact, you would have stopped buying in November of 2020 when the DCA Index risk model got above 50. You would have spent $25,000. So that's less than $10,000 per year invested into Bitcoin. And your profit just on Bitcoin over the length of that period, you can see how it played out right here. Your profit at the end on Bitcoin alone would have been $172,000. Or I'm sorry, your total account value. So your profit would actually be closer to $150,000 because the profit would be 172K that you made minus the 25K that you invested. All right. And we can come over and do this for Ethereum too. By the way, let me just say, this is by far the least interesting chart we're going to look at because I don't think this tells you a lot. Fine, you made money by investing in Bitcoin in a bear market. Congratulations. Anyone can do that. But there's specific nuances to this that we're going to get into. Okay, so this is the chart for Ethereum. And the way that we use the DCA Index risk model, I didn't really talk about this there, but I'm going to sort of elaborate on it here. With the DCA Index risk model, I will when I sell my Bitcoin, we know that alt season usually starts after, after Bitcoin has peaked out on the DCA Index risk model. So like back in 2018, Bitcoin hits its peak, then the alt market hits its peak. Back in 2021, Bitcoin hits its peak in February, March, April, and then altcoins go on their run. Okay, so we take 25% of the profits from Bitcoin. So you can see that indicated right here by total ETH investment of ETH, the amount that you dollar cost averaged plus your Bitcoin profits. So you take that total amount that you invested into Ethereum, which is $10,450 by the very end. So over that same 3-year stretch, you invested $10,500 more or less by the end. But you take 25% of the profits that you made from Bitcoin. So you're taking profits in December, January, and February, and you put those into Ethereum. So why did I choose 25%? I could have hypothetically taken 100% of the profits from Bitcoin and invested them into Ethereum, but that's not realistic. If you're someone who invested $25,000 into Bitcoin over a 3-year period and then $10,000 into Ethereum over a 3-year period, you're probably not someone who has, you're sitting on $10 million, right? You're probably someone who kind of, you have a normal job like a lot of us do, and you're just taking your paychecks and you're investing what you can, right? So you're not like a broke college student per se, but you're also not someone who's probably, flying around on their own private jet. So when that person makes $150,000 in profit on Bitcoin, that's very likely not going to be a small sum for them. And so to think that that person's going to take 100% of the profits and put that into Ethereum, it's not realistic, because that person typically wants to make sure that they lock up some of those gains that they've made. So we only transfer 25% of that profit that we made on Bitcoin. So more or less, it's about $40,000 that we take. So when do we do that? We do that in December, January, and February when we're making our profits on Bitcoin. We're moving the profit from Bitcoin into Ethereum, because as we know in the crypto market, it's typically Bitcoin goes first and then the altcoins go. And so we transfer that money in order to try and capitalize on that impending alt season. And that's exactly what we see. So right when we transfer that money, you see that we're sitting south of $100,000 in total account value. Then when we start putting that money over from Bitcoin into Ethereum, that's when the account value just goes wild. And it goes all the way up to around $250,000. Okay, so this summarizes, you invested $35,500 between Bitcoin and Ethereum over a 3-year period, so just north of $10,000 per year. Your total account value at the end is $377,920. Not bad for investing about $10,000 a year, right? But what does that require? And that's what we're going to look at next, because that sounds great. That sounds easy. And like we said, no one cares. Fine, you made some money by investing in Bitcoin and Ethereum in a bear market. But let's look at what sort of mentality that ultimately takes. Okay, so this is the dynamic dollar cost average strategy if you were investing in Bitcoin and Ethereum through COVID. And I'm choosing this specific time here for a reason. So, you're investing, and let's suppose that right now it's the end of 2018. And I want to show you why this approach is so difficult for people to actually follow through with. If you're sitting here in December of 2018, you've invested through this point. We'll look at that in a moment. But overall, your investment is down all through the beginning of 2018. So right here is the 0% line, the break-even line. All through the beginning of 2018, you're pretty much only down. All through the middle to end of 2018, you're only down. And then as you're down 20% or more, as your dollar cost averaging every week, you're investing, and now your account is worth less than it was the week before. It's worth less than it was the week before. And this just keeps going on. As you're doing that over and over and over again, then the market crashes on you. So for your diligence and your hard work and your patience, you are rewarded by getting absolutely slapped as the market, it goes down another 50%. And in fact, your account value is down around 55% at its worst during this entire cycle. But notice what happens there then. So your account value is absolutely wrecked. You're down 54% in December of 2018 just by investing weekly. But then what happens just several months later? Well, in June and July, your account value goes up 100%. So your account just absolutely takes off. So you can see that at the beginning of July of 2019, your account is up exactly 100%. But then what happens? There's another market sell-off. And at the COVID capitulation event, your account is back down to around 17% in loss. So this ride during a bear market, it's an emotional one. It is extraordinarily emotional, and it's very difficult to keep focus the entire time. It's very difficult to take a look at the market, your account's down 54%, and then to invest 3 times as much as you just did several months prior. Because in order to appropriately use a strategy like this, which maximizes your gains, you have to be willing to sort of stick through it. And let me show you why that is. So let's assume that you used a static dollar cost averaging strategy. So we can actually see that when we take a look at all of the investment, you on average invest about $150 per week. So if you're using a static dollar cost averaging strategy, and that's indicated by the blue line here, you are worse off in every stage of the market cycle, essentially, than using a dynamic dollar cost averaging strategy. And that is because you are spending relatively more during the higher price stages of the market, while the person who's using a dynamic approach is spending much more when the market is near its bottom. Okay, so a dynamic dollar cost averaging strategy is going to put you in a position where you end up acquiring much more of the asset. And now I'm going to show you exactly how that plays out. So first things first, this is the dynamic versus a static dollar cost averaging strategy. And this shows you how much you've invested throughout the market. Notice that in pink, this is the dynamic approach. You end up at $35,500. With the static strategy, investing $150 per week, you end up at the exact same amount. But notice where you're doing the investing at, okay? So with the dynamic approach, you're front loading. In other words, you're investing more at the beginning, because notice when we get up here, when the price here is approaching 2021, when the price is approaching, up to 30K, 40K, 50K, during that time, you stop buying Bitcoin because you extend above the 50 range on the DCA Index risk model. But this guy keeps on buying, right? Because he's listening to George tell him to buy the dip. So he keeps buying throughout the bull market. The dynamic dollar cost average guy, notice where the dollars that he's spending, notice where they peak. And they're rising more rapidly in the super bearish stages of the market, like right here at the end of 2018, at the beginning of 2019. Then they sort of trail off, like here in 2019, in the middle of 2019, when the market is going more bullish, okay? But this guy just keeps on buying. Now, here is when we get to the very interesting metrics. This shows you the average cost of Bitcoin that you've acquired with both a dynamic and a static dollar cost average strategy. By the way, I love it. Every video I make, the interesting parts is when anyone who might be new to the channel, they're long gone. So, to my loyal watchers, thank you very much. Thank you for making it this far. You're always rewarded, typically at the end of the video, because I have no conception of how to put interesting things at the beginning of the video. I only know how to put extraordinarily boring things at the beginning. So this shows you the dynamic versus the static dollar cost average strategy cost basis. And this is the crux of this entire video. The guy who's using a dynamic dollar cost average strategy ends up having an average Bitcoin price of $6,379 compared to the static dollar cost average buyer who ends up at over $8,000, okay? And that's for Bitcoin. We can also look at this for Ethereum. And we see a similar thing. The average acquired for Ethereum on the static approach is $250, whereas it's closer to $190 for the dynamic dollar cost averager. Okay, and then ultimately, this is where everything comes together. So recall the guy who's using a dynamic dollar cost average approach, how much Bitcoin does he end up with from 2018 through 2021, investing a base amount of $100 a month? And the dynamic dollar cost average guy ends up with around 4 Bitcoin, where the static dollar cost average guy ends up with right around 3.1 Bitcoin. So that's a huge amount when you consider the fact that you're selling the Bitcoin when it's at $60,000. So just the Bitcoin acquired, just the difference in the Bitcoin acquired is going to be around, 0.82 Bitcoin. So that is going to be a huge sum. That's going to be, that's going to equate to around $40,000 to $50,000 difference in the account value at the end of this entire approach. Notice that the static dollar cost averager has slightly more Bitcoin at the very beginning, but then right here, when the market becomes bearish, that's when the dynamic approach, that's when it shines. That's when you're acquiring huge sums of Bitcoin. So this guy, this static approach guy, he's buying he's buying the same amount of dollars of Bitcoin at 50K as he is at, 30K to relate it to today's terms. Whereas this guy, he's going heavy at 30K and he was barely touching the asset at 45, 50K. Okay. And then we can do the same thing then for Ethereum. And you can see that with Ethereum, you finished up with around 56 Ethereum by the end of this entire thing. All right. And then for the static approach, you finished up with around 42.5. So that's another huge sum when you consider that we were selling a lot of this Ethereum all the way up at around 4K, right? Because that's where we sort of started hitting our peaks for Ethereum in the early parts of 2021. And when you consider this, when you consider just simply how big of a difference this is, it's huge because you're spending the same amount of money. So using a static dollar cost average approach is always going to be, in my opinion, my opinion and the data's opinion, it's going to be vastly worse than using a dynamic approach. So when we look at the account value for the guy who acquired dynamically Bitcoin only, this is only his Bitcoin value, he finished up at around $225,786. The static guy finished with a Bitcoin account of $176,000, so a full $50,000 difference. And then we can do the same thing for Ethereum here. And you can see that the guy who dynamically approached Ethereum finished with an account value of around $220,000, whereas the static approach guy finished with an account value of $167,000. So the bottom line here, guys, I think I've demonstrated it quite clearly. This is a long ass video. But what we're saying is there is a huge advantage to doing two things. A, having a model which can indicate to you where the top is and where the bottom is. B, the fact that using a dynamic approach is vastly superior to a static approach. And in fact, there's a third point that we would be remiss if we didn't just harp upon, especially as we're sitting here at 30K, sentiment is at an all-time low. If you are investing in this asset and you feel like crap about your investments because they're down, you feel like crap because all of your investments are down significantly right now, all you have to do is think back to this chart. Think back to the guy investing in 2018 who's getting absolutely wrecked. He's down 55%. Here in December of 2018, and then he comes over to his Bitcoin chart and he says, it's December of 2018. I'm down 55% on my account right now. He can only imagine that the market goes down. He doesn't know anything else. It's only been going down. He looks over at the risk metric and he says, how much do I dollar cost average this month? He only knows, losses at this point because the market has been doing nothing but going down. We're sitting at 9. My account's down 55%. Crap, I have to invest $300 this month into Bitcoin. Well, guess what? That $300 that he invests right now, when the market looks like crap, when the market's all the way down, if we just measure from where it was back then, the market's down 83% at that point. Everyone and their mom is telling them that Bitcoin, it's going to zero. It's a stupid investment. You're embarrassed to talk about it in public. Well, guess what? This guy ain't embarrassed of nothing in February. Okay. When he's sitting on $200,000, all in part because of that investment that he made into Bitcoin. And then he transfers it to Ethereum. It exponentially grows from there. He finishes out by investing $35,000 by the very end and comes away with that in a conservative fashion by only moving 25% of his profits into Ethereum. He comes away with $400,000 by the end. So that's how you do it, guys. It's not easy to do. I promise you it's not easy to do. And if you're in these markets right now, I'm sure you know it's not easy to do whatsoever. But at the end of the day, investing takes conviction. It takes a lack of emotion. It takes a plan, and it takes sticking to that plan. And so that's going to be it for this one, guys. Until next time, as usual, see you.